Welcome to Talk Tickers.
It is great to be back here.
You know, usually when we sit down to do one of these deep dives, we're looking at something really flashy.
Headline grabbers.
Exactly like the latest AI breakthrough or a biotech stock that just tripled overnight, or maybe some massive merger that is going to shake up an entire industry.
The stuff that makes the ticker tape scroll fast.
Yeah, exactly. But today we are looking at a topic that, I have to be honest, at first glance, looks completely sleep-inducing.
I had a feeling you might say that.
I mean, we were talking about US Treasury bills, government debt. It is basically the vegetables of the financial world.
The ultimate boring asset.
The thing you buy when you want zero excitement in your portfolio. And yet, as I really started getting into the data for this deep dive, I realized I was completely wrong.
It is not boring at all.
Not even a little bit. This isn't a story about boring debt. This is, and correct me if I'm off base here, this feels like a story about the plumbing of the entire global economy getting ripped out and replaced while the water is still running.
That is the perfect analogy. You nailed it. We are looking at the convergence of the oldest, most established money in the world, which is the $27 trillion US Treasury market.
37 trillion.
Yeah, massive. And it is converging with the newest, fastest, and honestly most chaotic financial rails in the world.
The blockchain.
Precisely. The blockchain.
Yeah, like the meeting of old money and new rails.
Exactly. And what we are seeing right now in early 2026 isn't just a pilot program anymore. It isn't just some crypto startup trying to hack the system in a garage.
Right.
We are talking about the adults in the room. We're talking about BlackRock, Franklin Templeton. They are moving sovereign debt onto the blockchain.
So we call the show Talk Tickers, but today we are really talking about the industrialization of crypto finance.
We absolutely are.
So let's set the stakes here for a second. Why does this matter to you listening to this right now? Because for a long time, the narrative was that crypto was the rebellion.
And anti-establishment.
Right. It was down with the banks, down with fiat. And now you were telling me the biggest story is that crypto is absorbing the most establishment asset on Earth.
That is the irony, isn't it? But you have to think about the core problem. The US Treasury market is the bedrock. It is the risk-free rate. It is the collateral that underpins literally everything in global finance.
But the tech behind it is archaic.
It runs on infrastructure built in the 1970s. It has operating hours.
Which is crazy to think about.
It sleeps on weekends. It takes entire days to settle.
And money in 2026 does not sleep.
Money moves at the speed of light now, or at least information does. So when you take that risk-free rate and put it on rails that operate 24/7.
Like that settle instantly.
Exactly, instantly. And they are programmable. When you do that, you aren't just changing how you buy a bond. You are fundamentally changing what money is.
Okay, I am hooked. I am totally ready to eat my vegetables today. So let's map out exactly where we are going on this deep dive. We need to start with the basics first. Like, what exactly is a tokenized treasury, and how is it different from a stablecoin?
That is the foundational question.
Then I want to get into the history, specifically that absolutely terrifying weekend with Silicon Valley Bank, because I think that is the key to understanding the whole why now aspect of this.
Absolutely. That weekend was the catalyst for everything we're seeing now.
Right. Then we need to look under the hood at the actual mechanics. How does the settlement work? What is a rebase? And we need to talk about the major players.
BlackRock's BUIDL and Franklin Templeton's FOBXX.
Right. And the infrastructure making it happen, like Chainlink. And finally, we have to cover the risks, because if I have learned anything hosting this show, it is that there is no such thing as a free lunch.
There is always a catch. Always.
And we will end with the one specific question every investor needs to ask before they even touch this asset class.
Let's dive in.
Okay, topic one, defining the instrument. When I hear the phrase tokenized treasury, my brain immediately goes to crypto dollar.
Like a stablecoin.
Yeah, exactly. We all know USDC, we all know Tether. How is this any different?
It is a crucial distinction, and honestly, a lot of people in the market still get this wrong. Let's start with the stablecoin. Think of USDC or USDT. That is basically a digital dollar bill.
Okay.
It is a bearer instrument.
Meaning if I hold the keys, I own the money.
Exactly like physical cash in your wallet. If you have a $20 bill in your pocket, nobody knows it is there. It is yours.
And I don't need permission to spend it?
Right. You can spit it on coffee. You can hand it to a friend. You can accidentally drop it in the street and lose it forever.
Yeah.
Stablecoins are designed to be a medium of exchange. They are built for payments.
Okay, so they are cash.
Yes. And crucially for the holder, meaning you and me, They generally do not pay any yield.
Right. If I hold 10,000 USDC in my wallet, it just stays $10,000. I don't wake up a year later and have $10,500.
Correct. The issuer like Circle or Tether, they take your actual fiat dollars, they invest them in traditional T-bills, they earn the 5% yield, and they keep it.
Oh, wow. So they are keeping the yield.
That is their entire business model. They provide the utility of a fast digital dollar, and the cost you pay for that utility is the foregone yield.
Okay, so a stablecoin is essentially a checking account that pays zero interest.
That is a perfect analogy. Now let's pivot to a tokenized treasury. This is entirely different. Think of it as a high-yield savings account or a money market fund.
Okay.
It is a registered security. It is not designed for buying coffee. It is designed for corporate cash management and institutional collateral. And most importantly, you get the yield.
So structurally speaking, what am I actually holding? If I buy a tokenized T-bill, is there a physical piece of paper somewhere with Talk Tickers LLC printed on it?
Not a physical piece of paper, no. But there is a specific entry in a legal ledger. A tokenized treasury is a digital representation of a U.S. government debt security, but it is recorded on a blockchain.
But it is not a synthetic rate.
No, definitely not. You aren't just betting on the price movement of a T-bill. You have a direct or indirect legal claim on the actual underlying asset.
And where is that underlying asset? Because it certainly isn't living on the Ethereum blockchain.
Right. The blockchain can't hold physical or traditional paper assets. The T-bill itself sits with a qualified custodian.
Like a bank?
Usually a massive, boring, traditional bank like BNY Mellon or State Street.
Yeah.
They hold the asset in their vault electronically speaking. The blockchain token you hold is just a secondary record that proves you own a specific slice of what is sitting in that bank vault.
So it is essentially a bridge. The asset is trapped in the old world, but the ownership record is floating in the new world.
Exactly. And because it is a registered security, you cannot just send it to anyone.
Wait, why not? I can send my Bitcoin to anyone on Earth in 2 seconds.
Because Bitcoin is permissionless. Anyone can use it. Securities are permissioned. To hold a tokenized treasury, you have to pass KYC.
Know your customer.
Right. And AML, which is anti-money laundering checks, it is what we call a walled garden on the blockchain.
That distinction right there, the bearer instrument versus the registered security, that is massive. One is digital cash and the other is a legal investment contract.
And that naturally leads to the big why question.
Yeah, why go through all this hassle? Why build this incredibly complex bridge between a traditional bank vault and a decentralized blockchain? Why not just log into your brokerage account and buy the T-bill there?
I assume your first guess is speed.
Yeah, speed has to be part of it.
Speed is a huge part of it.
Yeah.
But it's also about pure utility.
Yeah.
Let's look at the traditional world. If you buy a T-bill, normally it settles T+1.
Meaning 1 business day later.
Right. Which honestly doesn't sound like a long time until you are in the situation where you really need the money immediately.
Right. 1 day is an eternity in modern markets.
Exactly. And it is not just the day. It is the specific hours. Traditional markets close at 4 p.m. Eastern time. They close entirely on weekends. They close on bank holidays.
I have absolutely felt this pain personally. You see a massive market opportunity on a Friday night, but all your cash is locked up in a money market fund until Monday morning. You are effectively paralyzed.
Paralyzed is the exact right word. We call that dead capital in the industry. Your money is essentially turned off. Now contrast that with a tokenized treasury. It can settle T0.
Instantly.
Atomically, instantly. And the network runs 24/7, 365. So if you're a global trading firm and you desperately need to move collateral to meet a margin call in Singapore on a Sunday night.
You don't have to wait for New York to wake up on Monday.
Exactly. Tokenized treasuries allow you to move that value instantly anywhere in the world at any time.
And you are earning that 5% yield the entire time it is moving?
That is the magic. In the crypto ecosystem specifically, this was a massive breakthrough. Because for a long time, if you were a crypto hedge fund or a Web3 company, you kept your dry powder in stablecoins.
Earning absolute zero.
Right. Which brings us to the historical context. Yeah. Because this whole tokenized treasury market didn't just appear out of nowhere because some developer thought it was a cool idea.
No, it was forced into existence.
It was forced into existence by 2 massive macro shifts. We really have to talk about the ZIRP era.
Zero interest rate policy. The free money era.
It feels like a lifetime ago, doesn't it? But you have to remember just a few years ago, the Fed funds rate was practically zero. T-bills paid nothing.
Right, so if you were holding millions in USDC and earning zero, you honestly didn't care because the alternative also paid zero.
The opportunity cost was zero. So the crypto natives didn't care about US debt. In fact, if you wanted yield in crypto back then, you weren't looking at safe government bonds. You were looking at DeFi.
Decentralized finance.
Right, you were doing yield farming lending protocols, highly speculative experimental stuff, because that was literally the only place on earth to find a return.
I remember those days clearly. The concept of risk-free didn't exist in crypto, so everyone just piled directly into massive risk.
But then came the inflation turn.
The Great Awakening.
The Fed started hiking rates, and they hiked them aggressively. Suddenly, the risk-free rate is 4%. Then it is 5%.
And the math on balance sheets changes completely.
It flips completely upside down. Suddenly, holding a non-yielding stablecoin is incredibly expensive. Let's say you have $10 million in USDC, sitting idle, waiting for a trade. You are effectively losing $500,000 a year in foregone interest.
Just by sitting there.
Just by sitting there. So institutional investors looked at their balance sheets and said, we cannot do this anymore. We need the safety of the dollar, but we need the yield of the Fed.
But they didn't want to leave the blockchain ecosystem to get it. They had gotten used to the operational speed.
Exactly. They didn't want to go back to T+1 settlement and dealing with fax machines and banking hours. They wanted that Fed yield directly on the digital rails.
Oh, so that was the demand side, the pull factor.
Right. But there was another catalyst, a much, much scarier one.
Yeah.
A push factor. We have to talk about March 2023.
The banking crisis.
Mm-hmm.
Silicon Valley Bank.
The weekend. The entire tech world held its breath.
I remember it so vividly. It was a Thursday afternoon when the rumors started, and by Friday morning, the news broke that regulators were literally shutting down SVB.
Seizing the bank.
Yeah. And initially, it really just felt like a localized tech startup problem. But then the contagion spread directly into the heart of crypto.
It went straight for the so-called safe asset. It went for USDC. Circle, the company that issues USDC, is a massive, highly compliant, transparent company.
They are the good guys of crypto.
But it turned out they had roughly $3.3 billion of their stablecoin cash reserves sitting in an uninsured account at Silicon Valley Bank.
And SVB was closed, the doors were locked, the regulators were inside.
Nobody knew if that $3.3 billion was just gone. Poof. And look at what happened to the price of USDC on the open market that weekend. It depegged.
It dropped to, what, like 88 cents?
Yeah, like that, yeah.
I remember sitting at my desk watching the chart and just thinking, this is mathematically impossible. A digital dollar backed by real dollars is supposed to be a dollar. Always.
That weekend was the massive aha moment for institutional crypto. That was the moment the entire industry collectively realized that off-chain traditional banking risk was actually their biggest liability.
That is wild.
The crypto natives had spent a decade worrying about smart contract bugs or getting hacked by some syndicate. But the thing that actually almost took down the entire ecosystem was a totally normal, regulated, traditional bank failure.
It is deeply ironic, isn't it? The crypto guys were always scared of the banks, but they still had to use them.
It is deeply ironic. But that pure fear drove immediate innovation. Smart investors realized that having a direct legal claim on US Treasuries managed via a transparent blockchain ledger might actually be significantly safer than an uninsured cash deposit at a commercial bank.
Let's break that down for the listener. How exactly is it safer?
Well, if you have money sitting in a bank deposit account, you are legally an unsecured creditor of that bank. If the bank fails and there isn't enough money to go around, you just get in line with everyone else and hope for the best.
Right, you might take a haircut.
But if you own a T-bill that is held in custody for you, and your ownership is recorded on an immutable blockchain, even if that custodian bank completely collapses, the asset itself is segregated. It is your asset. The bank's creditors cannot touch it.
So the sudden move into tokenized treasuries wasn't just about capturing that 5% yield.
Right.
It was essentially a flight to safety. It was about removing the counterparty risk of the commercial banking layer entirely.
Exactly. It was a flight to safety, but specifically a flight to on-chain safety. And the numbers back this up completely. If you look at the data from 2025, the total market for tokenized treasuries hit $7.3 billion.
$7.3 billion. That is up, what, 256% from the previous year?
Yes, over 250% growth in 12 months.
That is exponential. This isn't a niche little experiment anymore.
This is a fully fledged financial sector now.
So let's talk about the people actually building this sector. Who are the architects here? Because we aren't just talking about some guys in a basement coding smart contracts in their hoodies anymore.
Far from it. The absolute heavyweights of traditional finance have entered the ring. And you have to start by looking at BlackRock.
The world's largest asset manager. 9 point something trillion under management.
10 trillion plus, depending on the day. When BlackRock moves, the entire market stops and listens. And they launched something called the BlackRock USD Institutional Digital Liquidity Fund.
Wow, that is a mouthful of corporate jargon.
It is, but they call it BUIDL for short. BUIDL, which is actually a very cheeky nod to the old crypto slang HODL.
I kind of love that Larry Fink is out there approving crypto slang for his ticker symbols.
It shows they are paying attention to the native culture of the space. But make no mistake, this is a very serious, highly sophisticated product. BUIDL launched directly on the public Ethereum blockchain.
Not a private bank chain, public Ethereum.
Yes, and that was a massive signal of legitimacy for Ethereum as a network. But the fund itself is strictly for what the SEC calls qualified purchasers. You usually need a cool $5 million minimum investment just to even knock on their door.
So this is purely for the big fish.
Yeah.
This is for corporate treasuries, hedge funds, family offices.
Correct. Retail is not buying BUIDL. They use BNY Mellon for the actual custody of the physical bills.
Yeah.
But the real innovation, and this is the magic part of the whole setup, is the atomic settlement feature via USDC.
Okay, break that down for me. What does atomic settlement actually mean in practice for a fund manager?
It means instant absolute liquidity. Usually if you are parked in a private traditional fund and you want to get your money out, it takes time. You submit a redemption request, they have to sell off underlying assets. Then they eventually wire you the cash days later.
Which again is dead time.
With BIDL, BlackRock has set up intelligent smart contracts that allow you to exit the fund instantly directly into USDC. You can go from owning a yield-bearing treasury fund to holding a liquid stablecoin in a matter of seconds 24/7.
That seamless integration is key, isn't it? It makes the mutual fund behave exactly like cash.
Exactly. It blurs the line between an investment and a checking account. Then on the other side, you have the early pioneers like Franklin Templeton. They have their FOBXX fund, and they have actually been grinding at this since 2021.
So they were way ahead of the curve.
Very early. They were the first U.S. registered mutual fund to ever use a public blockchain to process transactions. They actually use the Stellar and Polygon blockchains instead of Ethereum.
Interesting.
And they have taken a slightly different approach than BlackRock. They built a consumer-facing mobile app called Benji.
Benji. Like Benjamin Franklin.
I assume that is the joke, yeah. But the app is attempting to bridge that massive gap to retail access. So while BlackRock is staying strictly in the high-level institutional penthouse, Franklin Templeton is down in the streets trying to figure out how to get this tech into the hands of a much broader audience.
And then there's another name I keep seeing constantly in the data. Ondo Finance. They seem to be absolutely everywhere right now.
Ondo is a fascinating case study because they act as an aggregator or a wrapper.
What does that mean exactly?
They realize that not everyone has $5 million sitting around to put into BlackRock's exclusive fund. So Ondo literally takes these institutional ETFs, like BlackRock's, and they wrap them into their own tokens that are completely accessible to the broader decentralized finance market.
So they are basically the bridge between the high-walled garden of BlackRock and the open Wild West field of DeFi.
Exactly. They created a product called OUSG. The Ondo protocol buys the underlying ETF, holds it securely, and then issues its own token that represents a proportional share of that ETF. It totally democratizes access to institutional yield.
Okay, I want to get a bit technical for a minute. We have talked about how these things work conceptually, but what does it actually look like to execute a trade? Let's role play. Say I am a corporate treasurer. I have $10 million in cash. I want to buy some BUIDL. Walk me step by step through the architecture of that trade.
Okay, let's look under the hood. First, you have the issuer, which is BlackRock. They create the fund. Then you have a crucial middleman called the transfer agent. In BlackRock's case, they partner with a specialized tech company called Securities.
The transfer agent is basically the official record keeper?
Yes. They are the legally recognized entity that officially says yes. Talk Tickers LLC legally owns this many shares of the fund. That is a strict regulatory requirement. The blockchain token is technically a secondary synchronized record. But here is where we hit the friction we talked about earlier, the whitelist.
The walled garden.
Exactly. Unlike Bitcoin, where I can send value to anyone, anywhere on Earth with zero permission, I cannot send a BUIDL token to you unless your specific crypto wallet address is on the official whitelist.
So I have to physically go to Securitize, upload my corporate documents, my passport prove I am not an international money launderer, prove I am an accredited investor.
Yes, all of the standard traditional finance paperwork.
Yeah.
And here's the cool part. The smart contract itself enforces this rule. If I try to be sneaky and send my BUIDL tokens to your non-verified wallet, the transaction will literally fail on-chain.
It just rejects it.
The code essentially checks a global registry and asks, is this receiving wallet authorized? If the answer is no, the transfer is instantly blocked. It cannot happen.
So the code literally becomes the law, or at least the code automatically enforces the law without needing a human compliance officer.
Precisely. It completely automates compliance at the protocol level.
Okay, so I pass the KYC, I get whitelisted, I buy the token, time passes. How do I actually get paid the yield? Does a physical dividend check show up in my mailbox?
No, definitely no paper checks. There are generally two distinct mechanisms for distributing yield on the blockchain. Method A is called a rebase.
Rebase? That sounds like complex computer science.
It sounds intimidating, but it is actually very intuitive. Think of it as an accumulating mechanism. In the rebase model, the price of the token stays completely fixed at exactly $1. The yield you earn is paid out by giving you more tokens.
Okay, so if I hold 1,000 tokens,
and the annual yield is 5%, at the end of the year, you open your wallet app and you now have 1,050 tokens. The actual balance quantity increases automatically.
that feels exactly like my normal bank account. The value of $1 doesn't change, but my balance goes up every month when interest is paid.
Exactly. And that is exactly why it is so popular for corporate cash management. It perfectly maintains the traditional mental model of $1 always equals $1. This is exactly how BlackRock's BUIDL works.
Okay, and what is method B?
Method B is the net asset value, or NAV, increase model. In this setup, the number of tokens you hold stays exactly the same forever. You buy 1,000 tokens today, you have 1,000 tokens next year. But the actual market price of each individual token goes up over time.
So the token goes from being worth $1 to $1.05.
Right. This is much more common in traditional floating NAV mutual funds. And honestly, it is vastly better for tax accounting in a lot of jurisdictions.
Why is that?
Because you only realize the taxable gain when you finally sell the token. Whereas with the rebase model, receiving those new tokens every single day is technically a taxable income event every single day.
Oh man, that is a detail that probably keeps corporate accountants up in a cold sweat at night.
Oh, absolutely. The tax treatment of daily rebase tokens is an absolute nightmare that we do not have nearly enough time to unpack on this show today.
Fair enough. Let's pivot and talk about trust for a second, because we are talking about digital tokens floating in cyberspace representing real physical money sitting in a bank vault in New York. How do those two totally different systems actually talk to each other? How do I, as an investor, know the bank actually has the money they claim to have? This feels like the obvious weak link in the chain.
It is the weak link. In computer science and crypto, we call this the oracle problem.
So oracle problem.
Yes. Here is the fundamental issue you have to grasp. Blockchains are basically extreme introverts.
Introverts.
They live entirely in their own little bubble. The Ethereum blockchain knows absolutely everything that is happening on the Ethereum network. It knows every single transaction, every smart contract, every wallet balance. But it is completely blind to the outside world. It has no eyes. It has no internet browser.
Right. It can't just log into Yahoo Finance and check a stock price.
Exactly. It cannot independently verify a bank account balance at BNY Mellon. It cannot see the price of Apple stock on the NASDAQ. It only knows what is fed into it.
So if BlackRock comes along and says, hey, we have $100 million sitting in our bank vault, let us mint 100 million tokens on Ethereum, the blockchain just has to blindly trust them.
In the old centralized model, yes. But in the crypto world, trust me, bro, is not considered a valid security model. You need cryptographic proof. And that is exactly where infrastructure providers like Chainlink come into the picture.
Chainlink, so they are the oracle.
They are the decentralized bridge between the real world and the blockchain. They have a specific service designed for this called proof of reserve. Think of it as an automated continuous auditor.
How does it actually verify the bank, though?
A decentralized network of independent nodes securely checks the off-chain custodian's traditional bank account, usually through secure banking APIs, and then continuously reports that verified data directly on-chain.
So the oracle looks at the traditional bank, sees the physical cash, runs back to the blockchain and says, yes, confirm the money's actually there.
Exactly. And the brilliant part is you can program the token's smart contract to listen exclusively to that oracle. If the oracle reports that the real-world assets in the bank have suddenly dropped or gone missing, the smart contract can automatically hard pause the minting of any new tokens.
Wow.
It mathematically prevents the fractional reserve problem, where an issuer gets greedy and issues more digital tokens than they have actual fiat backing for.
It adds an undeniable layer of programmatic trust. It is not just some quarterly audit report PDF signed by an accounting firm that you just have to pray is real. It is a live, verifiable data feed.
Yes. And on top of that, Chainlink also provides something called CCIP, which stands for Cross-Chain Interoperability Protocol.
Let me guess. This solves the problem of multiple different blockchains not talking to each other.
Exactly. Because remember, the liquidity in crypto is highly fragmented. BlackRock built on Ethereum. Franklin Templeton built on Stellar and Polygon. What if you are an institution and you urgently want to move your tokenized collateral from one chain to another?
Bridging assets between chains is notoriously dangerous though, right? I feel like every time I read about a massive crypto hack, it involves a cross-chain bridge getting exploited.
Historically, you are 100% correct. Bridges are absolutely the most vulnerable point in the ecosystem. CCIP is trying to solve this by creating a highly secure, universal standard transport layer.
Like the TCP/IP protocol for the internet, but for blockchains.
That is the exact goal. So that massive banks and institutions can move these tokenized assets around the global ecosystem without the constant terror of losing everything to a North Korean hacker.
Okay, so we have covered the definition, we have done the history, the mechanics, and the Oracle infrastructure.
Yeah.
Now let's talk about the end user. Why does this practically matter to a portfolio? We touched lightly on capital efficiency earlier, but I want to get very specific here. Who is the absolute killer app user for this technology right now?
Right now, today, it is undeniably the corporate treasurer.
The CFO of a major company.
If you're a CFO, your absolute worst enemy is cash drag. It is money sitting in an account doing absolutely nothing. We talked about those traditional cutoff times. If you miss that 3 p.m. wire transfer window, your money goes to sleep for the night. You earn nothing. Tokenized funds allow a CFO to keep that money actively working and earning yield until 11:59 p.m.
Or move it on a Sunday night if a deal closes over the weekend.
Exactly. It effectively artificially extends the business day to 24 hours. But the far more exciting use case, the one that really gets the hardcore finance geeks out of their seats, is something called collateral velocity.
Collateral velocity. That sounds like a concept from a sci-fi movie. Break that down for me.
Imagine a massive quantitative hedge fund. Let's call them Deep Dive Capital for this example.
Catchy name. I like it.
Deep Dive Capital holds, let's say, $100 million in tokenized T-bills. They're safely earning their steady 5% yield. That is their boring, safe bucket of capital.
Okay. Safe, boring, protected.
But suddenly on a Saturday night, massive news breaks. Maybe is a shock election result in Europe. Maybe it is an unexpected tech breakthrough. And Deep Dive Capital's algorithms see a massive fleeting trading opportunity that they need to execute on immediately.
But their money is in the safe bucket.
Right. In the old traditional world, to get the raw cash to make that new trade, they would have to physically sell the T-bills.
Which instantly creates a taxable event. And they lose their long position on the yield. And they have to wait for the settlement to actually get the cash, which won't happen until Monday anyway.
Right, by which time the trading opportunity is completely gone. They miss the trade entirely. Now, in the tokenized world, they don't have to sell anything. They can take those $100 million in BUIDL tokens, pledge them instantly into a decentralized lending protocol or a digital prime brokerage smart contract, and borrow liquid stablecoin cash instantly against them.
Wait, so they keep the original T-bills?
They keep the actual T-bills, and more importantly, they keep earning the 5% yield on those T-bills while they are pledged as collateral.
That is insane.
And they get the instant liquidity to make their new high upside trade on a Saturday night. They are fully leveraging their safe assets without ever having to sell them. This is what we mean when we say it increases the velocity of collateral. The exact same dollar is now effectively supporting two entirely different financial positions at the exact same time.
That sounds incredibly economically efficient. But I have to play devil's advocate here for a second. That also sounds exactly like leverage. And leverage historically is what blows up financial systems.
It is absolutely leverage. You are completely right. But you have to realize this is exactly how the traditional repo market already works in Wall Street finance.
The repo market?
Yes, the repurchase agreement market. It is a massive, multi-trillion-dollar shadowy machine that greases the wheels of the entire global economy every single night. Tokenization doesn't invent leverage. It just takes the repo market and makes it vastly faster, totally transparent and accessible 24/7 to anyone with a whitelisted wallet.
Okay, but there is still risk, right? What if the market moves against them?
Oh, if the value of your collateral suddenly drops below the required margin threshold, you get liquidated instantly, period. Smart contracts have zero mercy. They don't call you on the phone and politely ask you to wire more money by Friday.
Yeah.
They just ruthlessly sell your assets at market price to make the lender whole.
Ruthless efficiency.
Exactly. It removes the human element of margin calls entirely.
We are also starting to see a shift to the long end of the yield curve too, right? It is not just these short-term T-bills anymore.
That is definitely the next major phase of this evolution. Initially, this whole space was entirely focused on cash equivalents, short-term T-bills, maximum safety. But now we are seeing platforms tokenize 10-year and even 30-year US Treasury bonds.
Which introduces duration risk.
Yes, but it also introduces massive opportunity. It allows sophisticated traders to execute complex yield curve strategies entirely on-chain. You can actively manage duration risk, basically betting on whether long-term interest rates are going to go up or down over years without ever having to leave the decentralized blockchain environment.
So the entire traditional bond market is just slowly, methodically being mirrored on-chain.
Piece by piece, asset by asset, yes.
Okay, we have painted a pretty rosy picture here so far. We have talked about efficiency, speed, yield safety, programmable collateral. But let's get real for a minute. What are the actual risks here? What could fundamentally go wrong with this new system?
There is plenty that can go wrong. It is not a utopia. First and foremost, we have to deal with the regulatory reality.
The SEC.
The Securities and Exchange Commission.
Yes.
Commissioner Hester Pierce has been very clear on this specific issue. She stated quite bluntly that tokenized securities are still legally securities. Just because you put a fancy technological wrapper around it and put it on a blockchain doesn't mean the old rules magically stop applying.
So the 1933 Securities Act, the 1940 Act, all the dense historical paperwork still completely applies.
All of it, every single page. And practically this means friction. We talked about the whitelist process earlier. That is a permanent feature of this ecosystem, not a temporary bug. Tokenized treasuries will never be as fluid or as freely tradable as a pure crypto asset like Bitcoin. They will always have a heavy layer of corporate bureaucracy attached to them.
Which, to be fair, is actually a feature for massive institutions who desperately want legal compliance. But I imagine it is a huge bug for the crypto purists and anarchists who want total financial freedom.
Precisely. But there is a silver lining to that regulation. Think about private keys. If you lose your private key for a self-custody Bitcoin wallet, your money is just gone. It is mathematical dust. Goodbye.
Right. There is no 1-800 number for Bitcoin.
Exactly. But if you accidentally lose your private key for a wallet holding tokenized treasuries, because there is a legally registered transfer agent involved, like securitized, there is technically a legal process to recover your assets.
Really? I didn't know that.
Yes. You can go to the transfer agent, prove your identity with your real-world documents, and they can technically unilaterally burn the frozen tokens in your lost wallet and reissue brand new identical tokens to your new secure wallet.
Wow, that is a massive consumer safety upgrade compared to pure crypto.
It absolutely is. But it also fundamentally proves that this system isn't truly trustless in the crypto sense. You are trusting the transfer agent. You are trusting the U.S. legal system to enforce your rights.
Okay, what about systemic risks? We talked earlier about the glaring mismatch between the 24/7 blockchain and the 9-to-5 banking system. That feels like a massive trap just waiting to spring on someone.
This is what analysts call the liquidity mismatch, or more informally, the Sunday night problem.
Walk me through the absolute nightmare scenario here.
Okay, let's paint the picture. It is Sunday night. Markets are closed globally. Something terrible happens in the broader crypto markets. A massive exchange collapses or a major stablecoin depigs again.
Total panic mode.
Total panic sets in. Everyone holding BUIDL or FOBXX suddenly decides they want out. They want raw cash right now. So they all hit the redeem button at the same time.
But the traditional banks holding the actual cash are closed.
The banks are closed. The U.S. bond market is closed. BlackRock literally cannot sell the underlying T-bills to generate the actual cash needed to pay out those mass redemptions.
So what happens? The smart contract just throws up an error message that says, pending, please wait until Monday.
Essentially, yes. The primary redemption mechanism grinds to a halt. Or, alternatively, if desperate people try selling their tokens in secondary decentralized markets, like on a DEX, there might simply be zero buyers willing to catch a falling knife. Who is going to willingly buy your tokenized T-bill on a Sunday night when the entire financial world feels like it is ending?
Right, so the secondary market price of the token completely crashes. Even though the actual physical T-bill sitting in the BNY Mellon Vault is perfectly safe, the blockchain token might temporarily trade at 95 or 90 cents on the dollar simply because nobody can access the underlying liquidity until the sun comes up on Monday morning.
Exactly. That is the crucial systemic risk. The asset itself is safe, but the real-time access to the value of that asset has a massive timing mismatch. Investors desperately need to understand that the promise of instant settlement on the blockchain completely relies on third-party liquidity providers being willing to take the other side of your trade when the traditional banking windows are nailed shut.
And if those liquidity providers get scared and step back, the window slams closed.
And you are entirely stuck holding the bag until Monday morning.
It is incredibly fascinating to see how the traditional finance giants are maneuvering around these risks and viewing the space. I actually saw some very interesting comments recently from Larry Fink, the CEO of BlackRock, specifically regarding the broader U.S. national debt.
Fink is essentially playing 4D chess right now. He has correctly identified the spiraling U.S. national debt as a primary long-term driver for broader crypto adoption. He basically stated publicly that if the United States government keeps running these massive, uncontrolled, multi-trillion-dollar deficits, global investors will inevitably lose faith in the underlying fiat dollar and actively look for hard alternatives.
Which historically usually means gold, but in the modern era means Bitcoin, digital gold.
Yes, exactly. But paradoxically, by actively tokenizing the U.S. debt, BlackRock is essentially making the fiat dollar significantly more useful on a global technological scale. They are massively upgrading the dollar's core infrastructure. So while high sovereign debt might naturally drive people to seek out crypto as an escape tokenization, might actually trap them back in the dollar system because it suddenly becomes the fastest, most efficient, most programmable collateral in the entire world.
It is a profoundly strange irony. The exact decentralized technology that was originally created specifically to bypass and destroy the traditional banking system is now being aggressively utilized to strengthen and entrench the banking system's most important underlying asset.
That is just the cyclical history of financial innovation. The pure rebels create the breakthrough tech, and then the massive incumbents swoop in and intentionalize it for their own benefit.
We are coming toward the end of our deep dive here today. We've thoroughly covered why the mechanics, the Oracle infrastructure, and the systemic risks. But we always like to leave our listeners with a practical tool, a clear lens to view this specific market through going forward.
We call it the one question.
Right. So for an investor looking at a tokenized treasury product today, whether it is for their massive corporate balance sheet or even just their own private portfolio, what is the single most important question they must ask before they wire any money?
The absolute critical question is this: does the digital token confer a direct legal claim on the underlying physical asset, or is it merely a derivative claim on a special purpose vehicle?
Whoa, okay, that sounds like heavy lawyer speak. Let's translate that for the audience. Why does that highly specific legal distinction actually matter in the real world?
It matters intensely in a bankruptcy scenario. It matters when everything goes wrong. You need to know with absolute certainty: do you legally own a fraction of the actual US Treasury bill sitting in a vault? Or do you merely own an unbacked IOU from a sketchy tech startup that happens to own the Treasury bill?
The legal difference there is absolutely everything.
It is the difference between keeping your money and losing it all. If the tech startup goes completely bust due to mismanagement or a hack, and you only hold a derivative claim on the startup itself, you might just get thrown in line with all the other unsecured creditors in bankruptcy court. You might eventually get pennies on the dollar years later. But if you have a direct perfected legal claim on the segregated asset held in custody, your money is likely perfectly safe, even if the issuing company completely vanishes overnight.
So in this world of new technological rails, the old school legal structure is essentially your only seatbelt.
Exactly. Don't just get blinded by the shiny 5% yield. Look extremely closely at the underlying legal structure. Read the actual boring prospectus. Know exactly what you physically legally own.
That is a critical takeaway. It is not just about auditing the smart contract code. It is about auditing the actual legal contract.
Exactly right.
Let's wrap this up. If we have to tightly summarize the current state of tokenized treasuries right now in 2026, what are the three big main takeaways for our listeners to walk away with today?
All right, takeaway number one. Tokenization is absolutely not about speculating on volatile price movements. It is strictly about fundamentally upgrading the archaic plumbing of the $27 trillion treasury market. It is a massive institutional infrastructure play. It is not particularly sexy to talk about at a cocktail party, but it is quietly revolutionary.
It is ultimately about making sovereign money move exactly as fast as an email.
Yes. Takeaway number 2. The unique convergence of high traditional yield, that solid 4 to 5% range, and high technological speed instant blockchain settlement has successfully birthed an entirely new financial asset class. We're looking at the dawn of internet-native sovereign debt. This is going to be a foundational building block for the entire future of decentralized finance.
And takeaway number 3.
The primary risk paradigm is completely shifted. It is no longer retail asking, is this weird token a scam? It is now institutions asking how legally liquid is this specific asset on a random Sunday night during a global panic. The risk has moved from existential fraud to complex operational and structural plumbing.
We are rapidly moving from a world of T+1 settlement to a world of absolute T0. The historical friction of traditional finance is just completely disappearing before our eyes. The real provocative thought I want to leave you with today is this. If code is law and the global dollar is slowly becoming just another piece of code who actually controls the future of the money supply, the central banks or the developers writing the smart contracts, are your internal systems even ready for collateral that moves this fast?
That's a $1 trillion question right there.
This has been Talk Tickers. Keep your eyes on the tape. See you next time.